Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are in sell-off mode here in the markets. The Dow is tumbling as recession worries rattle investors yet again. The sell-off today prompted by weak jobs data out this morning. We're going to get to that in just a bit, but you see it is now down 540 points there. The Dow now off to the worst start to the quarter since Q4 of 2008. Taking a look at the Dow laggards, they include Chevron, Walgreens, and Cisco, as well as Amex at the bottom of the screen. The only Dow leader here, surprisingly, Johnson & Johnson. We'll get to that ticker in just a bit, but let's take a look at some of the other major indices to see how they are performing. And it is red arrows across the board. The S&P 500 down 59 points. And the NASDAQ down 149. Now, on the heels of grim manufacturing data yesterday, the latest ADP report is adding to those recession fears. Private payrolls rose by 135,000 last month, slightly missing median consensus expectations of 140,000. And that marks the smallest advance in 3 months. President Trump blaming the sell-off today on impeachment talk. Here's what he said in a tweet earlier. All of this impeachment nonsense, which is going nowhere, is driving the stock market and your 401ks down. But that is exactly what the Democrats want to do. They are willing to hurt the country with only the 2020 election in mind. Joining us now is Rachael Aiken. She is the vice president and portfolio manager at Rockland Trust. Rachael, let me just get your thoughts. What do you think is driving the market down today?
So I think you're spot on with the manufacturing data out yesterday, pointing to a recession in manufacturing, slowing job growth. Again, is kind of feeding into the psyche of investors and individuals alike that perhaps these are some cracks we need to look at. And what will that mean for perhaps recessionary times sooner or later?
We had a guest on yesterday who said, look, manufacturing numbers were certainly much weaker than expected. But if you look at the overall makeup of the economy, we're still talking about 10%. Services, obviously, a much bigger component there. Why do you think that over the last 2 days, we've seen the kind of steep reaction in the market to that number?
Well, and October is definitely one of the most volatile months on record. But it is times where we put in bottoms and perhaps then move forward. I think you're absolutely correct. Manufacturing is less than 10% of employment and GDP alone. But I think the fear is that that type of weakness in manufacturing will start to spread out and impact non-manufacturing PMI, which we're going to be looking at tomorrow morning. That indicator really impacts the bottom line of our consumers. And let's look at GDP. The consumer, which has been doing all the heavy lifting, is more than 2/3 of our GDP number. And we really need to be concerned about not only the health of the consumer today, which we think is quite strong with household savings rates the highest in a decade, household wealth, again, strong decade highs, as well as job gains. But in the future, will the manufacturing weakness feed over into non-manufacturing sectors? And will that flow to, quite frankly, businesses fearful of hiring? And once we see an unemployment number perhaps tick up, if that takes hold, that will really impact the soft data as far as consumer confidence and business confidence as well. Which could be a self-fulfilling prophecy as far as weakness in the economy.
So let's talk about the jobs numbers. We got that ADP report out today. A slight miss there, but of course the big number we're looking to is later this week on those NFP numbers. What is your expectation on that front?
So the ADP number is a good gauge of what the job market is doing. It still looks healthy. It's not necessarily the best predictor of what the payrolls number will be on Friday. We're still anticipating on average growth between 125 and 145, which would keep the economy well above the 100,000 job creation number that it needs to be at for the economy to continue to stay at this level or grow.
And Rachael, you mentioned some of the concerns that are out there, that what's happening in the manufacturing sector could really spill over into some of the other sectors. Could you argue that that's already happening?
I think, anecdotally, we do see the apprehension perhaps of businesses hiring, and that may be the one piece we can look to if that feeds through into the data. When you're looking at some of the soft data as far as consumer expectations for growth moving forward, that has tended to soften. Consumer confidence is off high levels, but still high. And again, I think once you start to see some of that soft data or more feelings flow through to the hard data points, it'll be easier to connect those dots. So we're going to definitely be keenly looking at what goes on with earnings season for the health of the stock market, but also look at job creation, what the Fed speakers are having to say this week, especially Powell on Friday, and really dig into that non-manufacturing number that we get tomorrow.
And Rachel, bottom line, what does this all mean from an investment standpoint? Are you looking at your portfolio to say maybe it's time to switch things up going into year end, or is this kind of the time to stay firm?
So at Rockland Trust, we strongly believe in strategic asset allocations and having our clients set the right asset allocation from the beginning. We think it's been extremely important because the market has been so volatile, and that while we seem to be pedaling in place from October 2018 to October 2019, there have been opportunities to rebalance and add to positions in order to have our portfolios in good stead and on target. So for our clients, we would definitely recommend staying the course, making sure that your asset allocation matches your risk tolerance, and being vigilant and monitoring what you have.
Okay, Rachael Aiken with Rockland Trust. Great to have you on today.